Hi everyone, a very good morning to everyone for joining us today. We are pleased to run through today's UOB quarterly invest performance update. I'm Roger, a member of the UOB customer success team. The first quarter of 2022 have been a challenging one, and we are pleased to invite Mr. Damo Sujanto, Chief Investment Strategist for UOB Invest, to share with us on all our portfolios of performance and insights into second quarter 2022. Before we start, here are some housekeeping rules that we'd like to share with the team. The checkbox is available if you have any connectivity issues, whereby you can raise them to the Zoom host. Polls will appear on screen for your selection and results will be shared. Click onto the Q&A icon to ask any questions throughout the session. Click on the like button to upvote any questions raised in the Q&A section as well. Scan the QR codes with your phone to access the feedback form at the end of the presentation, and also to click on any links available in the chat box to access to the feedback form as well. So without further ado, let's go into the agenda for today. We'll start off with the market commentary, and then we will have Damo to run through the performance updates for both our corporate robo and our retail robo for first quarter 2022. After which, he will also share a little bit in terms of the market outlook and the strategy from UOB AM going into second quarter 2022. Let's now invite Mr. Damo to come online. Damo, please.
Thanks, Roger. Good morning, everyone. Thanks for spending your morning with us to run through what has happened in the first quarter in the market and what we expect going into for the rest of the year. Right. If I may start, we started the year with expectation that this is a mid-cycle expansion. But I think there are two things that surprised us in the first quarter. I think in reverse order, I guess the first thing that really caught us by surprise was the Russian invasion of Ukraine, right? The geopolitical conflict in Russia was one of the major surprises. Nobody thought that Russia would really invade. Everyone thought that there'll be a lot of saber rattling and that would be it. But what happened was that Russia invaded, and what we saw was that as a result, oil prices sort of shot through the roof, right? Even before that invasion, there were already a bit of a supply shortage. When the invasion happened, and all the sanctions, there was basically disruption in supply from Russia and from Ukraine. And what we see is really a spike of oil prices from about 100 at the beginning of the year to at its peak was about 130. Today is probably more like 110. It's still very elevated. I think this is something that has happened that caught us really by surprise. The second thing that surprised us, if I may go to the next slide, was that basically the central banks turned very, very hawkish. This is actually the expectation. The light blue line is actually the expectation of how many rate hikes that the bond market have in terms from the Federal Reserve. Right, at the beginning of the year, if you look at the mark that says December 21st or January 22nd, people were expecting about 3 rate hikes this year. Okay, by March, the number is now about 8 hikes. Okay, we are expecting about 8 hikes or about 2 percentage point in interest rate hike for this year. This would make it probably make it the tightest or the most aggressive that the Fed has done since about 1994, where we had the bond market that lasted for about a year. So really there is now expectation, a very high expectation that the Fed will be very, very aggressive. And in fact, after last night, that number, the expectation is now closer to 10. Because people are expecting somewhere along the way, besides raising 25 basis points, at some meetings, the Fed might actually raise by 50 basis points or 75 basis points. So really, there is high expectation that the Fed would be raising interest rate very aggressively. And as a result of that, what we saw is that the 10-year bond yield went from about 1.5% at the beginning of the year and all the way up to 2.4% at the end of March, right? And today is actually more like closer to 3%. It's 2.9 plus. It's close to 3%. So there is really, because of the expectation of Fed tightening or central banks tightening, interest rate has just keep on going up and is going up very, very fast, right? And what's the reason behind that? If I may go to the next slide, it's really the sticky inflation, right? This is the US CPI number. And if you look at the US CPI number, the red line is reading is now about 8.5%, right? We've seen, and we've not seen this for a long time. I think since the global financial crisis, or since even before the global financial crisis, inflation probably maxed out at about 4%, right? This is really the sharpest that we have seen in a long time. And even the core inflation, meaning excluding food and energy, it is still about 6.5%. And there's quite a number of reasons for that. One is, of course, we have supply chain disruption. After COVID, there's a lot of production that was disrupted. But at the same time, there was still demand for goods, right? Because people were locked down, but they were still doing online shopping and they're still ordering goods. So the demand did not drop because income was supported by government subsidies and government transfer. But production was really affected. And as a result, we are seeing supply shortages. And of course, the whole US sanction on China did not help situation, right? Because US, the trade sanctions on China basically created uncertainty in terms of business activity and production. So that didn't really help as well. So for the past year or so, we're actually seeing shortage of semiconductors, which basically goes into everything. So as a result, there's been sort of shortage of vehicles, of cars. In the last month, the latest car sales number in the US is 13 million annualized. That is actually much lower than the normal run rate of about 17 million. And that 3 million odd in terms of shortage is not about it's not about demand, it's not about the lack of demand, but it's actually supply. The supply couldn't catch up. And as a result, what we see is that used car sales prices actually shot through the roof, right? It was up 20% on a year-on-year basis. And of course, the opening up of the economy, people started traveling, airline ticket prices went up, hotel prices went up, because airlines have been cutting down capacity during the COVID. Now suddenly everyone wants to travel, and then there's a lack of airline capacity. So all these are basically pushing your inflation rate higher. And of course, today there's also other, what we've started to see is also things like labor shortages in the US and in some of the developed market. Even in Singapore, you notice that there is, to a certain extent, labor shortages that's pushing up wages. So the latest wage growth in the US is almost 5%, which is actually, again, the highest in decades, right? So that's basically the reason why the central banks, especially the Fed, has to be so aggressive in terms of their posture of increasing interest rates going forward for the rest of the year. If I may go to the next slide, what we are seeing is not just in the US. In Europe, we are seeing the same. We're seeing the same trend. If I may have the next slide. In Europe, we are actually seeing the same trend. Basically, inflation is running at decades high, and today is running at close to 6%. And this is the February number. We haven't gotten the March number yet, but this is really, again, very, very sharp inflation. We suspect that the March number will be even worse because Eurozone obviously is most impacted by the conflict between Russia and Ukraine, right? Europe is heavily dependent on Russia for its energy. It imports a lot of oil and gas from Russia. And this disruption is definitely going to hit Europe harder. Already we are hearing electricity prices double and triple. Excuse me. Double and triple in certain countries, and obviously petrol prices has gone up significantly as well. And you have to add to the fact that we now have a refugee crisis in Europe, in which that you have refugees coming into Europe, and that is probably going to mean a lot more demand while supply is disrupted. So that would actually push up inflation in Europe, right? So Europe, we think is probably going to be even more impacted than the US. If I may go into the next slide. This is the situation in China. I think you've probably heard it. China began to lock down some of its major cities since about mid-March, right? This includes Shenzhen, which probably is a very, very significant production hub for China, as well as Shanghai, right? The recent news was Shanghai was locked down. You hear a lot of stories out of that. That really is going to disrupt the supply chain even more. And today, even if you can produce out of Shanghai, there is a bottleneck in Shanghai port as a result of this lockdown. So what we are going to see is that the supply chain that was poised to ease, since last year, people increased production and things we are hoping that the supply chain bottleneck will start easing. Looks like, if anything, is going to worsen for a while before it gets any better. And this really had an impact on China production and China economy. If you look at the left-hand side of this chart, basically we saw that this is the Chinese PMI number, and the production, new orders, new export orders have all fallen below 50, which basically means it is in the contractionary zone, right? So China is really an extra wild card that is disrupting the supply chain and probably aggravating the whole inflation pressure. So it's really something that we need to watch closely, but we think that this means that inflation would stay higher for longer. Let's go to the next slide. What does that all mean? So basically, initially, even as interest rates sort of went up, equities market held up relatively well, right? The concern was really in the bond market because yield was going up. Equities actually managed to hold on relatively well, but that changed, I think, somewhere about late February, when Russia invaded Ukraine. Equity market basically started selling off, right? So if you look at it at its worst, the Asian market was actually down almost more than 15%, and then of course it climbed back a bit, recovered a bit, but at the end of the quarter, it's still down about 7.6%. The global market was actually more affected by the higher interest rate in the US. So that took a hit first, and after the sort of Russian invasion, it sold off as well, but also again it recovered. So today is, by the end of the quarter, it's down about 4.8%, right? So this is really the equity market, right? And this is actually a relatively volatile market. And part of the sell-off in Asia is as well also because of the concern that US would actually tighten sanctions on China. I think there are views that China is supportive of Russia, and because of that, there were threats that US may actually sanction China, and therefore the Asian market really sold off harder during that period of time. Okay, if we go to the next slide. On the bond market side, this is really what we saw in the bond market. In the Asian and the global bond market, we actually started seeing the bond prices coming off even from the beginning of the year as interest rate starts going up, or interest rate expectations started going up. So you can see that it was almost a straight line down. In the yellow line, which is the global number, and then the blue line is basically the Asian number. That really went down almost in a straight line and down by about 5%. The Asian high yield market is actually hit worse. It closed the period down almost 10%. And the reason is really what we've seen was that besides during the Russian Ukraine conflict, there were concerns about the Asian bonds. There were also episodes in which the Chinese developers were defaulting, right? I think you saw that in January. There was already a bout of sell-offs because of Chinese developer defaulting. That really caused the Asian high yield market to sell off. And then subsequently, during the Russian crisis, they sold off more simply because it was risk off. And then fortunately, there's a bit of clawback going into end March, but that still leaves us about 10% down. Whereas at the bottom of the market, the Asian bond was actually down 15%, or Asian high yield bond was down about 15%. So that's really the episode. And if you had noticed, this is quite unusual, right? Usually we always say that bonds are more defensive than equity. In a down market, bonds usually fall less. But if you notice the number in this quarter, bonds actually fell more than equities. The bond market, the global bond market was down 4.9. The global equity market was down only 4.8. So that's really highly unusual, right? I mean, obviously, if you annualize this number, it's about 20% loss, which is highly unusual for the bond market. You know, in a bond market, usually don't lose this much money. It is an anomaly. It is probably something we don't see very often. In fact, it's rare that even in my career, which is over 20 years, have I seen bond market being more volatile than the equity market, right? So that's what we have seen in terms of the situation in the market. And let's go into what has happened to the portfolios as a result of this market situation. What we've seen is actually on the corporate robo side, on the very conservative portfolio, we've seen about 5.8% decline in the performance, right? And that really accounts for really most of the losses for the year. 5.8%, the allocation for this portfolio is really all bonds. There is no equities in here. There's a global corporate bond, and then there's Asian bond, US government bonds, Sing bond, and money market fund. But money market fund was only about 5%, so that wasn't big enough to save the portfolio, because that was really last year when we positioned this portfolio end of last year, volatility was still very low, and therefore there was allocation towards Asian bond to try to get a bit more yield, but that really has sort of has not worked out for us in this quarter. So as a result, the bond market is, this portfolio is down about 5.8%, right? If I may go to the next slide, this is the conservative portfolio. And in this portfolio, there is actually some equities in here, right? There's some US equities, which is about 14%, the purple color slice, 14% of US equity. That actually helped us. That actually helped us a bit. Asia ex-Japan equity didn't really do that much, but the 14% in US equity sort of reduced our losses to about 4.5%. So that actually means on a 12-month basis, the portfolio is down about 2.6%. Since inception, is actually still positive, almost 4%. Right, so the equity market, as I said, this is really strange times that equity actually did better than bonds in a down market. It actually reduces the loss for us in this down market. If I may go to the next slide. In this instance, we are back to about 5.3% loss. And in this instance, basically the Asian high yield bond was probably a bit of a culprit in terms of dragging down performance, right? We were counting on Asian high yield bond to deliver higher return, but in this downturn, it actually became a drag for us. The US equity obviously now is a 24% sleeve. The biggest piece of that is US equity, and that helped us in terms of delivering the performance for this, in terms of reducing the losses for this portfolio as a counterbalance. So we end up with about 5.3% loss as a result. Since inception, this portfolio still delivered about 4.2%. So it's still a decent positive number out of this portfolio. If I may go to the next slide. This is where we got a bit more aggressive. Equities is now a significantly bigger piece. It's almost 46% of the portfolio. And obviously that 46%, the US equity 25%, that helped. Asia ex-Japan is now 21%. That sort of detracted. And then the Asian high yield bond at 16%, that's really detracted. But in the since inception number, this sort of positioning actually helped us deliver about 8.7%. So it's a pretty nice, still a decent return when we look at the since inception number, because the equities were actually very strong in the last 2 years and delivered those returns for us in the last 2 years, right? If I may go to the next slide. This is really on the most aggressive portfolio for the corporate robo. And again, we have now almost, call it 80% in risk assets, which is made out of 25% in US equity. That helped us. Global equity is probably sort of about 5% loss, right? That's 25%. So that 50% is doing all right. Asian ex-Japan equity, that's a drag, 23%, and then the 15% in Asian high yield bond is a drag, right? So that 38% is really quite a significant drop. And then the Asian bond was also a drag for us. So really, this is a sort of a half-half portfolio. Well, sorry, not half-half, but half of the portfolio was actually helping us. The other half was actually dragging us down. That's why we have about 6.4% loss. But actually having equities really did help us in mitigating the losses from the Asian bond side. And since inception, return is actually 17%, which basically gives us sort of an annualized return of about almost 5%. That's really a decent number, right? That's what we have for the corporate robo side. Let me move to the for the retail side. On the retail side, not much good news. If anything, what we've seen is that the 3 months actually was was a sharp drawdown, which basically dragged us down on the since inception and on the 1-year number. Right, this was actually delivering about 3-4% returns before this episode. Today is actually sort of dragged us down to a -4% for the year and since inception. And actually the biggest culprit in this instance, again, the retail robo is designed to be more aggressive than the corporate robo. You notice that even in this retail robo, there are already equities in there. 12% of Asian ex-Japan equities and 11% of US equities. The 11% US equities probably help us a bit, but the biggest chunk of it was actually Asian bond. That 35% of Asian bond was a big detractor. And this Asian bond, I must explain, was actually in emerging market sovereign bond fund or sovereign bond ETF. And this emerging market sovereign bond ETF has historically has a similar return and risk profile as Asian corporate bond index. And the reason we were moving into this ETF, I think in the last communication that we told you that we're moving into the emerging sovereign bond ETF, was that we were concerned about Asian bonds because of the Chinese defaults. There were quite a number of Chinese developers and Chinese issuers who were distressed and defaulting, that we felt that being in sovereign bond, abide in sort of emerging market sovereign bond, would be a better risk return proposition, because sovereign, governments almost rarely default, right? You can count the number of instances that government defaults throughout history, but whereas the corporates have a higher default likelihood. So we were moving into the emerging sovereign bond until, of course, Russian happens. Okay, so basically that was part of the reason why this chunk was actually detracting quite a bit. But what we've seen is that after February, actually in March, there was actually a bit of recovery, and we think that that episode is really one-off, and now it is behaving again like what it should, or as it normally should, meaning that we see sort of small up and down on a monthly basis, not the sharp drawdown that we saw in February for this ETF. So generally, that's really the main reason for this dismal performance on the very conservative portfolio. I don't think there's any way to sugarcoat it. Performance is disappointing, and that's really from the Asian bond chunk. If I may go to the next slide. This one, the losses were actually less. The US government bond obviously still lost money, simply because bonds were losing money. The US equity probably sort of saved a bit of that. And basically what we've seen is that the US REITs and the sort of global equity probably helped, but net, we still lost about almost 5% or 5.4% of the portfolio in this quarter alone. Right, before this quarter, this portfolio would have delivered about 9%, almost 10% return. This basically, we actually gave back slightly more than half of the return on this portfolio. If I may go to the next slide. This one, basically the bond side has actually reduced further to about 36% on the sort of US government bond. Instead, it is moved more into US equity, Asia ex-Japan equity, US REITs, as well as Asian high yield bond, right? So as you remember, the Asian high yield bond sort of detracted, but actually the equity and the REITs actually helped us regain some of that losses. So this portfolio and the previous portfolio, if you notice, performed almost equally. It's down about 5.5%. So it's actually almost equal to the previous portfolio. And because the performance of this portfolio over the last 1 year or before this episode was actually almost 15%. So we actually still had about almost 10% level of performance in this portfolio, right? If I may go to the next slide, the aggressive portfolio, if you notice, actually the government bonds is now down to only 21%, whereas the rest is equities. And no surprise, the equities actually helped us a bit, and we actually saw slightly less drawdown from this portfolio, and we retained more of the performance. The performance since inception is 17.6%. So basically, if you look at it, from the sort of moderately from the conservative to the aggressive, to the moderate to the aggressive, the performance is really that we are actually running at roughly the same kind of performance level, call it about low 5%, minus 5% return. But this one actually has retained more performance from previously. The last slide. This one, because there is more Asia ex-Japan equity, that actually took a bite out of performance, right? So there's no bonds in here. It's all equities, US growth, US equity, and US REITs, as well as Asia ex-Japan equity. The Asia ex-Japan equity probably was the one that dragged us down. And to a certain extent, the US growth equity probably also underperformed. So we actually lost about 7.6%. But this positioning delivered almost 30% return since inception before this current drawdown. So really, we've sort of still retained about 22% return, but it is something that it is difficult quarter. I mean, what we've seen is that market, there's almost nowhere to hide. Every asset class that we could invest in probably lost money in this episode, right? Let me go to the market outlook, what we think will happen for the rest of the year. Okay, as we mentioned, we started the year thinking that this would be a mid-cycle and the global economy will continue on an expansionary path. I think the narrative is this, right? Every economic cycle, or the average economic cycle, has been somewhere between 5 to 10 years historically. And the average length of the cycle is about 8 years, right? And if you think of 2020 as a recession year, 2021 as a recovery year, 2022, this year is only the second year in which that we've seen this cycle. So we thought that this is really just the mid-cycle, although there is interest rate starts to increase. Usually that is normal in a mid-cycle and the global economy will continue to grow. However, what we have seen is that we had two growth shocks, right? The Russian-Ukraine invasion, that was one growth shock, and we don't know the spillover effect into Europe. I think the expectation is that Europe will probably be affected. Europe growth would definitely be affected, partially as a result of higher energy prices. So that's one growth shock. The second growth shock is really the tight monetary condition, right? The expectation of monetary tightening is probably the second growth shock that we are seeing. already what we've seen is that the US mortgage rate has jumped from about 3% to 5% within this couple of months. And 5% mortgage rate, imagine if we have to pay 5% mortgage rate, can you imagine what's going to happen to our housing market? How many people can really withstand 5% mortgage rate before it affects our discretionary spending, right? So basically, we think that is the second growth shock that might happen, that might come from the US or and in developed markets in which the interest rate is rising rapidly. So this two growth shock has now raised the probability of a recession. We still believe it is not a base case. We still believe that given that job market is still very strong, wages are still rising, we think that this doesn't look like a recession. And so far, the economic data that has been coming through, despite the Russian invasion, despite the higher interest rate or higher bond yield, most economic data we see is still holding up pretty well. The one that has started to come down is really the confidence number. The consumer confidence and the business confidence have actually started to roll over, especially in Europe. It's actually rolled over very fast. So that's really what we are watching very closely. So from our point of view, recession is not a base case. But it is now a possibility rather than a remote probability, right? Is increased to a significant, not a major, but a significant possibility. And I think that's something that we are watching very, very closely. So we'll basically monitor the situation and formulate our investment strategy, but we encourage investors to hold on and stay invested through the market jitteriness. I think the temptation is really after a sharp sell-off, people pull their money out of the market, and you basically get whipsawed because you don't participate in the rebound or in the recovery, right? You took the losses, but you did not participate in the recovery. So something that we advise against. If anything, our advice is really, if you can afford it, do dollar cost averaging, buy a little bit more when market has already sold off, and that actually lower your average cost of your investment, right? That comes to the end of my presentation. If I may, I'll return it back to Roger.
Hey, hi, Damo. Thanks very much in terms of the insights provided, especially in terms of covering all the portfolios for both corporate and retail as well. And I think it's quite interesting that you brought up the last point in terms of the dollar cost averaging as well. So if we were to move on to the next slide, before we share a little bit in terms of some of the FAQs or some of the Q&As that we have, just want to share with everyone in the members of the audience today, right? We actually have started this RSP promo. So from 4th April 2022 until 30th of June 2023, be one of the first 1,000 UOB AM Invest users on the retail app to set up a 12 continuous months of regular savings plan with a minimum monthly contribution of $300. You'll get up to $50 credits. So this is a great way for you to take advantage of the current situation, regardless of how the market volatility is panning out. Like what Damo has mentioned, that it is a remote possibility of a recession, and the beauty of dollar cost averaging, I guess everybody is quite aware, is that you don't time the market at all. What matters is really the time in the market. At the same time, when the market prices are down, you actually pick up a lot more units. That's why it's called dollar cost averaging. So let me just quickly run through some of the potential questions that we have raised on our end as well. And Damo, I think you mentioned about in terms of the growth shock that we have seen, right? Especially on the aggressive monetary tightening by the central banks. And I think that kind of pans out what we have seen in terms of what we call the inversion of the bond yield curve. Maybe do you want to share a little bit more in terms of what does that mean to the members of the audience today?
Okay, sure. I think this happened about late March. What we saw was that the 2-year bond yield was actually higher than the 10-year bond yield, right? And that's an anomaly. I mean, if you lend people money, you expect that when you lend for a longer period of time, you expect higher interest rate than if you lend people in a short over a short period of time, right? So if you lend someone for 1 year, you expect less interest rate than if you lend someone for 10 years. I think of it in deposit is the same thing. A short-term fixed D would have a lower rate than a long-term fixed D. But in this instance, what we saw during that period of time was that the 2-year yield or the 2-year interest rate, think of it, the 2-year interest rate was higher than the 10-year interest rate. That basically suggests that the central bank is making a policy mistake, right? Because basically what the bond market is telling the central bank and telling everyone is that they expect in 10 years, going down 10 years down the road, the interest rate will be lower. And how could interest rate be lower? Is because with this tightening, there will be a recession, and after that, the central bank would have to cut interest rate, and therefore interest rate would be lower if you take a 10-year view. So that's really telling the central bank that they are making a policy mistake, that they are probably tightening too hard, or they are prepared to tighten. They're going to tighten too much, and therefore a recession will be coming. So usually, in fact, if anything, this sort of what we call yield curve inversion is a prelude to a recession, because it usually means that the central bank is making a policy mistake and tighten the monetary situation too hard, and therefore triggering a recession. So that's really what the inversion of the yield curve was.
Thanks, Damu, for the explanation. I guess everybody was looking at it from a headlines perspective, and usually, when this kind of phenomenon happens, right? I think the economists, the journalists will cover that quite a fair bit as well. So going back in terms of the portfolios, while we know that the portfolios have suffered for first quarter 2022, and I think you brought up quite a number of good points in terms of where we are looking at. And trying to, we are monitoring it on a closely basis as well. So in terms of the allocation, right? I mean, just to FYI to everybody in the audience today is that we don't really go into the sector allocation itself. The portfolio has always been structured in terms of a regional allocation. So from that perspective, Damu, do you want to share a little bit in terms of where we are looking at from a regional exposure perspective, so that the members of the audience today will feel a little bit more confident to know that whatever that we're positioning the portfolios is also in line with our house views, and that is also backed by how the investment team has been looking at.
Yes, sure. I think we just finished our investment committee meeting this week, and basically what we see, there are a few things. One is, of course, if we look at the region, we are inclined and tilted towards Asia. And there is a few reasons for that. One is after underperforming for so many years, Asia is actually cheap relative to the rest of the world, right? That's really the first thing. Second thing is, of course, we are looking to China reopening, because after locking down, during that lockdown, it's actually painful for the economy and sometimes painful for the market. But once they cannot lock forever, and when they start reopening, that pent-up demand and that sort of recovery usually delivers a nice lift to the economy and a nice lift to market, right? So that's what we are counting on. That with that reopening going into probably second half, and already we are hearing that some parts of some cities are already have unlocked. We think that this would probably give a lift to the economy and to the market. And of course, the Chinese government have set economic growth target of 5.5%, and they are actually falling behind. So we are actually expecting them to stimulate or to provide some stimulus in order to meet that 5.5%. They basically want to meet that 5.5%. What we've seen is that they've started to ease monetary condition. China is one of the few countries that is moving in opposite direction. As the rest of the world is tightening, China is actually easing. China is actually cutting the RRR ratio. China is cutting interest rates. So China, if anything, is easing, right? So that gives us a bit more comfort that there's probably going to be support there. And of course, for the rest of Asia, especially Southeast Asia, we are opening as well, right? We are opening borders. We are starting to allow travel. Thailand is allowing to start travel. Malaysia is opening up. And these are probably going to stimulate the economy, right? It may not be, we may not return back to the glorious days to be pre-COVID, but compared to last year, it's still going to be a significant pickup, right? Because last year, tourist arrival 0. Today, it's a small tourist arrival, but it's still better than 0, right? So you have that sort of situation. And Southeast Asia is also a major beneficiary of, if anything, of higher commodity prices. Right? We are Indonesia and Malaysia are big palm oil exporters. Malaysia is a big rubber exporter. Indonesia is a big coal exporter. These are all beneficiary of higher commodity prices. And so we think that net Asia is probably has a lot of engines that could drive growth and drive the market, right? And especially we are probably one of a few regions that's more insulated from the Russian conflict. The other area that we are probably a little bit more bullish about is the US. Although we do see sort of monetary policy tightening, but what we've seen is really the economic growth is still relatively strong. And again, they are not directly involved in the Russian conflict. And if anything, they have one industry that probably benefit from this conflict. I know it sounds morbid, but US is a major weapon producer. And with that, basically, we think that stimulates the US economy as well. So US is probably the other area in which that we are a little bit more comfortable in terms of our positioning.
Hey, thanks, Tamo. I think there were great insights in terms of providing some perspective and context into Southeast Asia as well. I think a lot of us have forgotten that Indonesia is actually one of the biggest exporters of commodities, and then with the rising prices, right? So that also leads to one of the questions that probably we have is that as closer to home, right? I guess everybody is feeling the pinch when the inflation starts to come in. We are seeing the core CPI's numbers have gone up. And our petrol prices are soaring as well. Whatever food I'm buying right now, it's also increasing in terms of the pricing and all that. So while there are some businesses that benefit from it, there will be some that actually suffer from it as well when it comes to raw materials as well. So from a top-down view, right? How do we see the inflation going to pan out? And are we even prepared for that when it comes to the portfolios and how we are positioning as well?
Okay, good question. I think before the Russian invasion and the China lockdown, we thought that the supply bottleneck would start easing this year, right? I think last year inflation started climbing. There was shortage of semiconductors. As a result, there was shortage of other products that rely on semiconductors. We thought that inflation would, that would ease this year, because once you have higher prices, it usually triggers a supply response, right? If semiconductor prices gone up because of shortage, it encourages semiconductor makers to expand their capacity and build more semiconductors. Similarly, anything that there is shortage and prices increase and profits are high, it attracts new supply coming into the industry. right? So that was what we were counting on. Today, unfortunately, we have Russia invasion that basically disrupts some of the things that comes out of the region, whether you're talking about oil, whether you're oil and gas, whether you're talking about wheat. They are a big major producer of wheat, and as a result, basically, grain prices have gone up across the board because everyone is looking for wheat alternative. And they are also a major producer of edible oil, sunflower oil in that region. And therefore, it has a knock-on effect on, say, palm oil, right? So, and then, of course, it didn't help that China locked down in March and probably stayed locked down in April, almost for the whole month of April. So that sort of disruption probably means that we have not seen peak inflation yet. That inflation will continue to remain high, probably for this quarter and maybe even Q3. So we probably see the peak in inflation in Q3 before the sort of the net starts rolling down. I mean, if prices start, inflation numbers starts rolling down simply because of the mathematics of it, because of the high base effect, right? So I think that net, we think that inflation will continue to remain sticky. And actually, if anything, inflation or slightly better inflation is beneficiary to some, actually to most equities or most stocks, because from a if you talk about stocks, companies' point of view, if you can pass on that inflation, or you can pass on that higher cost in terms of raising prices, actually the profit would be maintained and sometimes even higher. I mean, obviously, some sectors, as you mentioned, the commodities producers probably are enjoying very fat margins today, very high profit today, but even most companies would probably be able to protect their profit if they can pass on that cost. So in that way, really, in an inflationary environment, equities actually is a better inflation hedge compared to bonds, compared to fixed income. So what we are thinking of course, is on the fixed income side, we try to keep it relatively short duration if we can help it.
Hey, thanks, Damo. I think that's actually bring a nice end in terms of for today's presentation as well. And before we break for lunch, now I know that what I need to do in order to be hedging the rising inflation as well. I should be looking at trying to dollar cost average into my portfolios. And I think we have shared early on to the members of the audience today is that we have just launched the RSP promo. So take advantage of this situation. Take advantage of the promo as well to dollar cost average your portfolio. No doubt, the portfolios have been down for the past quarter. As what Damo have shared, the portfolios have actually been registering stellar performance since we started this as well. So let me just, if you have any, we do value your feedback as well. So please, click onto the feedback link found in the chat box and fill it up as well. And lastly, special thanks to Damo for sharing a lot of his insights today and also covering the performance portfolios as well. So if not, we will end today's session. Have an awesome day. Stay safe and goodbye.
Thanks, Roger. And thanks, everyone. Bye-bye.